Why is your credit score so important when you're applying for a mortgage? Hello and welcome to my YouTube channel. My name is Judith Vandenberg and I'm with Vandenberg Real Estate Solutions. Today we're going to discuss what a credit score is, how to improve your credit score, and how to keep it at a healthy level. When lenders review your mortgage application, they will look at factors such as your employment status, your income, the size of your down payment, and your credit. The lenders will also look at your credit report and your credit score to decide if they will lend you money. They will also decide how much they'll lend you and how much interest you will be paying on the money borrowed. What is a credit score? It is a number rating between 300 and 900. The higher your score, the more financially responsible you are, and the more attractive you look to lenders. Credit scores in Canada fall into 5 ranges. Poor, between 300 and 574. Below average, between 575 and 659. Fair, 660 to 712. Good, 713 to 740. Excellent, 741 to 900. To qualify for a mortgage, your credit score must be 680 or more. Some lenders will lend you money with scores between 600 and 680, but they'll charge you higher interest rates. You can check your credit score with companies such as Equifax and TransUnion. These private companies that collect, store, and share your information about how you use credit. So who can see and use your credit report? Credit bureaus follow rules that define who can see your credit report and how they can use it. Those allowed to see your credit report include banks, credit unions, and other financial institutions, credit card companies, car leasing companies, retailers, mobile phone companies, insurance companies, governments, employers, and landlords. These businesses or individuals use credit reports to help you make decisions about you. These decisions could be to lend you money, collect a debt, consider you for a rental housing, consider you for a job, provide you with insurance, or offer you a credit increase. When a lender asks you to check your credit, they are asking you to access your credit report at the credit bureau. This results in an inquiry on your credit report. Don't do too many credit checks at one time. Lenders may see this as a red flag and that you're urgently seeking credit or that you're living beyond your means. So how do you improve your credit score? You do this by improving payment history. Your payment history is the most important factor for your credit score. To improve your credit score, make sure you always make your payments on time. Make at least the minimum payment if you can't pay the full amount you're owing. Contact your lender right away if you think you're having trouble paying the bill, and don't ever skip a payment. Another way to improve your credit score is to keep your credit card balances low. If you can increase your credit card limit, having a higher credit card limit can increase your credit score. Try using less than 30% of the available credit. It's better to have a higher credit limit and use less of it each month. For example, if you have a credit card limit at $5,000 and your average borrowing amount is $1,000, your credit usage rate would be at 20%. If you use a lot of your available credit, lenders will see that as a greater risk, even if you pay down the balance in full by the due date. You can also improve your credit history. The longer you have a credit account open and in use, the better it is for your score. Your credit score may lower if you have new credit accounts. If you transfer old accounts to new accounts, the credit bureau will consider new accounts as new credit. Another way to improve your credit score is to limit your hard hits. Hard hits are credit checks that appear on your credit report and count towards your credit score. Anyone who views your credit report will see these inquiries. Hard inquiries can stay on your credit report for up to 2 years and can impact your credit scores for up to 1 year. You will end up with a higher credit score if you haven't applied for new credit. These hard hits include credit applications, rental applications, and employment applications. Diversifying your credit can also help you improve your credit score. Your score may be lower if you have only one type of credit product, such as a credit card. It is better to have a mix of different types of credit, such as a credit card, a car loan, or a line of credit. A mix of credit products may improve your credit score, but make sure that you're able to pay back the money you owe. Otherwise, you might end up hurting your credit score by taking on too much debt. Your credit score and your overall financial situation can greatly impact the home buying process. Before you begin the home buying process, check your credit report and your credit scores and take some time to address any information on your credit report that may be inaccurate or incomplete, and try to improve your credit health as much as possible. Some advanced planning may make a big difference when it's time to purchase a home. Thank you for watching. If you enjoyed the video, give me a thumbs up. And if you'd like to see more content every month, please hit the subscribe button below and don't forget to click the bell. We'll see you next time.